So listen closely. First, interest rates. Generally, banks offer lower interest rates because Hello and welcome to Tauch Len, Cambodia's trusted source for financial education. I'm Len, and today we're rediving into a question many of you have asked. Should I get my first loan from a bank or a microfinance institution? This is a huge decision, and getting it right can set you up for success. If you're planning to borrow for the first time, whether it's for your business, a new motorbike, or a family need, this video will help you make the smartest choice. Ready? Let's get started. First, let's understand the basics. Banks and microfinance institutions, or MFIs, both lend money, but they are fundamentally different. Think of it like this. Banks are like large established department stores, while MFIs are more like local, specialized shops. Banks primarily serve customers with stable, documented incomes like salaried employees or registered businesses. They offer a wide range of products, from personal loans to large corporate financing. On the other hand, microfinance institutions were specifically created to serve people who might be overlooked by traditional banks. This includes farmers, small street vendors, craftspeople, and entrepreneurs in rural areas who often lack formal paperwork, like salary slips or a long credit history. Their goal is to promote financial inclusion and help small-scale ventures get off the ground. So, while both offer loans, their target customers and core missions are quite distinct. Now, let's break down the key differences that will directly impact your decision. This is the most important part, so listen closely. First, interest rates. Generally, banks offer lower interest rates because they lend to lower-risk customers with stable incomes. They can afford to charge less. Microfinance institutions, however, usually have higher interest rates. This isn't because they are trying to be unfair. It's because they are taking on more risk by lending to individuals with fluctuating incomes and less collateral. Their operational costs to reach rural clients are also higher. Next, loan size. If you need a significant amount of money, say for a car, a house, or major business expansion, a bank is your best bet. They are equipped for medium to large loans. MFIs, as the name micro suggests, specialize in smaller loans. These are perfect for buying inventory for a small shop, purchasing fertilizer for a farm, or covering a short-term cash flow gap. Let's talk about the approval process. This is where the difference is night and day. Banks have a very strict and formal process. You'll need to provide a stack of documents: ID card, family book, employment contract, salary slips, bank statements, and sometimes a business license or collateral. It can take weeks or even months to get approved. Microfinance, in contrast, is known for a much easier and faster process. They understand their clients might not have all that paperwork. Their loan officers often visit you in your community, assess your situation directly, and can approve a loan in just a few days. So, to recap the target audience, banks are for formally employed individuals and established businesses. Microfinance is for farmers, vendors, small family businesses, and those in the informal economy. Finally, repayment terms. Bank loans, especially larger ones like mortgages, often have longer repayment periods, stretching over many years with a fixed monthly payment schedule. Microfinance loans typically have shorter terms, from a few months to a couple of years, and they can sometimes offer more flexible repayment schedules that align with a farmer's harvest cycle or a vendor's cash flow. So, if you're starting a small business or need quick cash for an urgent need, the speed and accessibility of microfinance might be the right choice. But if you have a stable job, can provide the necessary documents, and are looking for a larger loan like a car or home loan, a bank will almost always offer you better rates and save you money in the long run. Let me share a real-life example to make this clearer. Let's talk about Saka, a vegetable seller in Kandal province. Saka's business was doing well, and she saw an opportunity to grow by buying more produce directly from farmers and expanding her stall at the local market. She needed about 2 million reals to make it happen. First, she went to a bank. The bank officer was polite, but asked for proof of income, a business registration, and some form of collateral, none of which she had as a small-scale vendor. She left feeling discouraged. Then, a friend told her about a local microfinance institution. A loan officer from the MFI visited her market stall the next day. He talked to her about her business, how much she earns daily, and her plans for the money. He could see she was hardworking and had a solid plan. Instead of asking for formal documents, he assessed her character and her business's potential. Within just 2 days, her 2 million real loan was approved. Yes, the interest rate was a bit higher than what the bank would have offered, but that quick access to capital was exactly what she needed. Saka bought more vegetables, attracted more customers, and her income grew. The slightly higher interest was a small price to pay for the opportunity to expand her business when it mattered most. Her story shows how MFIs fill a critical gap in our financial system. So, how do you choose the right one for your specific situation? It comes down to asking yourself a few honest questions. First and most importantly, what is the loan for? Is it a small amount for a short-term need or a large, long-term investment? Your answer to this will immediately point you in one direction. Second, can you provide the documents a bank requires? Be realistic. Do you have recent salary slips, a formal employment letter, or a registered business license? If the answer is no, a microfinance institution is likely your more practical option. Third, and this is crucial, do you fully understand the repayment terms? Don't just look at the interest rate. Ask about all the fees, processing fees, administrative fees, and any penalties for late payments. Get a clear repayment schedule in writing. You need to know exactly how much you have to pay back each month and for how long. My strongest advice is this: always compare your options. If possible, talk to both a bank and an MFI. Get their offers in writing. Lay them out side by side, and please never ever sign a loan agreement without reading every single line. If you don't understand something, ask for an explanation. A good loan officer will be happy to clarify everything for you. Taking on debt is a serious responsibility, and being informed is your best protection. Now, I'd love to hear from you. Have you ever taken a loan from a bank or a microfinance institution in Cambodia? What was your experience like? Please share your story in the comments below. Your insights could be incredibly valuable and help someone else who is in the same position you were. If you found this video helpful and learned something new today, please give it a thumbs up. Subscribe to Tauch Len and hit that notification bell so you don't miss our future videos. And do not forget to share this with your friends and family who might be thinking about getting a loan. I post weekly videos just like this one to help all Cambodians make smarter financial decisions and build a better future. Thank you so much for watching. I'm Len, and I'll see you next time on Tauch Len.